Hello there and welcome to another video. Any questions? Leave them in the comments. And if you want to know more about investing in the stock market, check out the rest of my channel and subscribe. So not enough people are investing their money. They're making money, they're spending money, maybe they're saving a little bit of money, but they're not putting away anything for investments. And it's one of the biggest mistakes you can make in your life, period. Not just financially, guys. You need to put your money to work. It's the only way to build up wealth over time. And I like to call it paycheck to investments, where the money comes to you in form of income and it ends up as additional income for yourself. So eventually you will have income coming from your job and you will have income from this side from your investments, and it will all sort of be a good circle. And with the accumulative growth of your investments, this side might end up giving you more income than this side, and that's when you can quit your day job and sort of do whatever you want to do. So now we all make money, we all have a job, most of us anyways. So let's say you make $3,000 a month. This is just a number. I chose not to go with like a round number like 10,000 because it's more than most of us make and it's a little bit hard to get your head around it. So this is a pretty realistic number for most countries. So let's say you start off with $3,000 every month after taxes. It's a lot, but let's say. Now, first of all, we'll have bills and we'll have to spend money to live, have a certain quality of life. So let's say you spend a little over 50% on bills and spending. So let's say $1,600. It's a quite low living expense and not a lot of spending. But if you really want to build a strong portfolio of investment, you need to save as much money as possible. So $1,600 for, rent, gas, food, clothes, etc., and travel. Then maybe you're able to put $200 in a savings account. Now this is just money for a rainy day. This is not, or maybe you're saving up for something you have to buy, like a car, a new washing machine, a new PC, or a phone, or something that will enable you to fully, live your life. So at least put a little bit aside in a savings account for a rainy day, or if you're saving up for something. But the majority of the money outside of bills should go into your broker's account. Your broker is where you actually buy stocks. Now, if you're using your bank as a broker, as many people do, you don't have to put it into a broker's account. You can just have a separate account in your bank where you put the money you're thinking of investing. Or you can put it straight into stocks. You can skip this step. So if you're a really good saver, you might be able to put $1,200 into your broker's account, but at least put $1,000. If you're making $3,000, you should be able to invest $1,000 a month. Now, it might sound ridiculous for you to save this amount of money and to spend so little, but think about how much money you spend on things you don't need, things you definitely don't need, just things you want. I do it myself, but I try to restrict it to the most necessary things and then treat myself a little bit time from time. So from your broker's account, what I would do is to put most of the money straight into an index fund. It could be an index fund or a Vanguard ETF. It could be an S&P 500 fund or a total stock market fund, a US fund, a tech index, whatever. You can either go with a mutual fund through your broker, or you can go with an ETF from, let's say, Vanguard. So just put the money straight in. Don't save up a lot and then invest thousands of dollars. Just invest straight away every month. Don't worry about timing the market. Don't worry about expenses. Just put it into an index fund. the rest, so the $400 which are left after you put $800 into an index fund, should go in some sort of savings account. So either keep it in your broker's account or have a separate bank account where you save up $400 a month, and when you have a couple of $1,000s, like let's say $2,000, you invest it in individual stocks. So companies which you think are going to beat the market, outperform the market. So ideally, this post should do better than this. That's basically what you're trying to do. And the reason why I wouldn't invest immediately is you should only invest this money when you think there's an opportunity to outperform the general market. So if you don't have any great companies or great timing strategies, you should just keep that money in an account ready to be invested, so you don't have to take from savings or the bills. Okay, now you notice these small red C's, that stands for commission or expense. So it does cost something to invest money, and those costs occur in this part and in this part. Every time you buy or sell a stock, you pay a one-time fee. It's a transactional fee. It's usually not more than $7 or $8, maybe 10 if you have an expensive broker. And with index funds and ETFs, you pay an annual management fee to the company managing the fund. So if you want to have as little expenses as possible, you go with an ETF. But if you want to invest straight through your broker in the mutual funds they provide, let's say you're using Vanguard as your broker, you can buy a Vanguard mutual funds. But ETF in the long run will usually outperform mutual funds. In terms of individual stocks, you only pay a one-time fee, then nothing else apart from if you sell. Now, from these investments, you might get something called a dividend. So what I would do with the dividend is probably put it back into my broker's account and let it sit there till I have enough to buy, a substantial amount of stocks. Some companies does offer a dividend reinvestment plan, aka DRIP, which means the dividend goes straight back into the stock without any fees. You don't have to worry about it. It just sort of puts the dividend into the same investment. But most companies just gives you the dividend to your broker's account or to a bank account, and it's usually very little at a time. $5 here, $10 there, $20 there. So save that up in the account, and the next time you invest, you can just add the dividend on top of the $1,200. This way, you save money on expenses, because if you just invest a little bit at a time, the expenses, the transactional fees, are going to make up such a big part of your amount. So this is how I would do. The goal is to have income from your job, income from your stocks, income from your dividends, maybe even interest on your savings. You can start a business with this money. You can invest and buy assets like real estate, and in the end, this ideally will give you freedom and set you free. You can quit your day job and do whatever you want to do with all of this passive and active income coming towards you. So that's how I think you should spend your paycheck. Let me know how you guys do it, or if there's any better way of structuring your investing strategy. As always, check out the rest of the channel or visit investingforall.net. See you in the next video.